My name is Fahim. Thank you for joining us on this webinar today. I can see quite a few participants now joined in, so I believe we can kick off. So yes, I think we have been holding a series of webinars last year and early this year as well. So we're happy to continue that now. Thank you for joining us. Today's topic is a little bit different than what we would normally do with our focus on Kuwait tax. Today we're going to be looking at the implementation of corporate income tax in the UAE. We'll be going through some of the timelines, the key features, the interplay of free zones. And throughout this, we want to give a Kuwait feel to it, right? So we want to understand how does this now impact businesses that operate in the UAE that are Kuwait headquartered or Kuwait based. I think you would have also seen from media reports that there is a tax treaty also being negotiated between the UAE and Kuwait. So we'll also try to bring that in a little bit. It is not in the public domain as yet, so a lot of it will be a bit speculative. However, given our experience on tax treaties and typically how they work, I think we'll give some insights there as well. So if we can go to the next slide, just go over some of the agenda. So it's 60-minute sessions that we're planning. We're hoping for 10 minutes at the end to respond to some questions. Please use the chat function to ask your questions. We'll be monitoring that throughout the session, and where we feel we need to provide inputs, we can do that. Otherwise, we will try to address what we can at the end. If we can't get to your question, don't worry. We'll keep a track and we'll try to reach out to you separately on that. The session is being recorded, so please keep that in mind. And we will be circulating a link on our social media platforms shortly after the session. Okay. So with that, I think if you go to the next slide. Yes, so today I'll be moderating the session. I'll have Naveen with me from our Kuwait office, who's the director in our group. But most of today you'll be hearing from Ramia. Ramia, thank you very much for joining us. She is part of our practice in the UAE. We've been working with Ramia for a few years now on transfer pricing engagements, but more recently a lot of focus on UAE impact assessments for our Kuwait-based clients that have operations in the UAE, and also BEPS 2.0 engagements. So Ramia, a very experienced person. We're very happy to have her on board today. And with that, Ramia, I'd hand it over to you to take us through the developments.
Thank you, Fahim, and hello, everyone. Good morning, good afternoon, wherever you are. So where are we? Corporate tax in the UAE and the current status. As you all are probably aware, UAE did announce the corporate tax legislation earlier this year on the 31st of January, coupled with certain FAQs and preliminary details. On the 28th of April, the Ministry of Finance released a public consultation document, which essentially provides certain principles and concepts and the basis on which the proposed UAE CIT regime would be based on. And this was available to the public, including businesses and tax advisors for consultation and inputs. Where we are right now is, the Ministry of Finance is looking through the inputs that they've received, and the CT law is expected to be released shortly. Yes, businesses are eagerly waiting for the law to be released. But in the meantime, we thought, as Fahim mentioned, we thought we would have an initial session on what the proposed law would mean. And this is largely based on, and today's session is largely going to be based on the public consultation document and some of the other developments around, say, tax residency rules or the potential UAE-Kuwait tax treaty. And we try to make this session a little bit more relevant from a Kuwaiti standpoint so that you guys can get a feel of what it means for your business operations in the UAE. So let's start with the key features of the UAE corporate tax legislation. So the effective date, when we talk about the effective date, it is going to be effective for financial years starting on or after 1st of June 2023. For most businesses having a December year end, the first CT year is going to be 1st of January 2024 to 31st of December 2024. As per the current guidance, there is a 9-month period for the filing of the corporate tax return and for CT payments. And essentially, for a year ended 31st of December 2024, this would fall on the 30th of September 2025. As immediate next steps, as soon as the CT law is announced, one would require to look at the provisions and tax disclosures that need to be made to the financial statements. So that is a housekeeping point that one needs to look at. Moving on, there are, when we talk about the corporate tax rates, yes, there is a headline rate of 9% for taxable income above 375,000 dirhams. Now, while we say headline rate, there is a possible 15% rate also potentially going to be applicable, because both the announcement and the PCD do reflect something around a different tax rate, which is aligned with the global OECD-based Pillar 2 provisions. So under OECD BEPS 2.0, Pillar 2 or global minimum tax of 15% has been proposed, and it is expected that large M&E groups with a consolidated group turnover of more than euro 750 million would fall within this bracket and would be subject to a higher tax rate of 15%. Again, the mechanism of how this would be applicable, whether it will be a straightforward 15% or whether it would be a differential tax, which is going to be collected as a top up over and above 9%, is yet to be clarified. If I were to just take a step back and give you an example on how the tax would be applicable. So let's take an example of, say, 500,000 dirhams of taxable income. So the 9% would apply only on the 125,000, because 375,000 dirhams would not be taxable. So that's how the UAE would apply a progressive CT tax rate system. When I talk about just in terms of completeness, let's also speak about the withholding tax implications. So there is a proposed 0% withholding taxes on domestic and cross-border payments, which would be made by UAE businesses. Moving on, around taxable persons. So if I were to look at taxable persons, the PCD provides, in summary, any person which is conducting commercial activities under a commercial license would be a taxable person. Does this include natural persons? So the answer to that is natural persons would be taxable only on income earned from business activity carried out in the UAE. So if a natural person has income in his personal capacity, for instance, say through employment income or rental income on property which is owned in his name and not through a commercial activity, then this would not be subject to taxes. All UAE businesses, including banks, so this includes branches and free zone mainland entities or foreign PEs operating in the UAE under a commercial license, would be subject to tax. What about non-resident persons? So the PCD suggests that non-resident persons subject to UAE CT on taxable income from their permanent establishment in the UAE and UAE sourced income. When we talk about permanent establishment, the PCD does defer back to OECD guidelines, but only with respect to fixed place of business and dependent agent test. Also, under fixed place of business, it would be for a period of 6 months rather than 12 months as stipulated under the OECD guide. UAE sourced income, and if we were to just talk about what is UAE sourced income, it essentially means income from activities undertaken in the UAE or from assets which are owned in the UAE. There is also a concept of of transparent entities. So limited and general partnership and other unincorporated JVs and association of persons will be treated as transparent for CT purpose. What this means is that these entities are not taxable, but then the question is whether the partners would be taxed on such income. PCD has provided that LLPs would be taxed in a similar manner as a UAE resident company and would not be considered transparent. There is also an indication for a legal person incorporated in foreign jurisdiction that is effectively managed and controlled in the UAE to be treated as a resident and to be treated as a taxable person in the UAE. Recently, there was second. Yeah. So recently there was an update to the UAE tax residency rules. While there was no criterion for businesses effectively controlled and managed in the UAE, there is, the residency rules have referred back to the tax laws of the country to establish residency, which means that we have to wait for the tax laws to specify as to what would constitute effective management and control in the UAE. But just to give some more context to this, we do have an example on the next slide. So in this case, you have a UAE co which owns 100% stake in a Kuwaiti company, and Kuwaiti company can be said to be effectively managed and controlled by UAE co. Now you would ask me, what do we even mean by effective management and control? So as an example, you could have certain senior management sitting out of the UAE company. All the strategic decisions probably are being taken in the UAE. It is established that, by virtue of minutes of the meetings or board meetings are being held in the UAE. So based on certain instances, it can be established that the UAE company is effectively managing or controlling the Kuwaiti company. In this instance, what happens is that Kuwaiti company will be considered as a resident for UACT purpose and will be taxed on its worldwide income. So just to take a pause here around, what will happen in case of in view of the UAE Kuwait tax treaty, and what is the implication from a Kuwaiti standpoint. um, I would request Naveen to share his thoughts on this matter.
Yeah, thank you, Ramya. Good morning, everyone. Good afternoon. Ramya, thank you for that. I think, see, while the UAE Kuwait tax treaty, the draft has not been available in the public domain, but based on the normal parlance, if you look at the treaties have been signed to avoid any double taxation, right? So, I mean, we have to look at it in case of the dual residency, because if the Kuwaiti company is seen as a resident in Kuwait for the tax purposes because they are incorporated in Kuwait, and as per the local law of UAE, if the Kuwaiti company, because of the effective management and control, they are seen as a tax resident in UAE, I mean, it becomes a dual residency. But the treaty normally will kick in if there is a double taxation. At the moment, because Kuwait does not have a corporate tax applicable on Kuwaiti companies, and it is limited to the foreign shareholders in Kuwaiti companies, right? Since Kuwaiti companies are not subject to tax, but they will be subject to tax in UAE. I mean, it would be interesting to see how the Kuwaiti tax treaty with UAE would be seen. But in normal international tax parlance, because there is no tax being paid in Kuwait, there may not be any benefit which a company would be able to claim in this scenario if they pay any taxes in UAE, because there is no double tax being in this particular scenario. So that we have to still see how the treaty would be addressing this topic.
Yeah, and Ramya, if I can add, I think this is the very key point that I think we need to just emphasize. Currently, Kuwaiti companies typically, if you're a standard WLL, you don't pay any tax in Kuwait. There are certain minor levies such as zakat or national labor support tax if you're a Kuwait shareholding company or listed. So, but even then, it comes to a maximum of 4.5%. Now, typically when you're looking at effective management and control, what you're saying is that if, say, the owners of a business are having meetings and board meetings and executive management is sitting in the UAE, that Kuwaiti company, even though it's not paying tax in Kuwait, would be subject to tax on its worldwide income in the UAE. And that's quite significant. So you're going from a very low tax base or nil, effectively a nil to a very low tax base to paying 15% tax on your worldwide income of the Kuwaiti business, even though it's a Kuwaiti company, just because of where the decisions and the effective management is being undertaken. That's so I think that's definitely, I think from an organizational governance perspective, something that companies need to look at to understand, are they going to have to change the way they operate in terms of governance decision making? Is there any risk involved? And I think that's something that businesses are already starting to do, indeed. So I think that that's really why we're saying that, look, even though it's a UAE legislation, it is powerful enough to actually, cause a tax impact on Kuwaiti businesses, even if it's Kuwait sourced income. Yeah.
And Fahim, just to add in, I mean, in Kuwait, there are a lot of foreign companies who are having 49% stake. So in Kuwait, the local company does not pay any taxes, but the foreign companies pay their taxes on the share of profits. So in this particular case, if effective management is considered as in UAE company, and then if the Kuwaiti company pays taxes in UAE, the foreign shareholder would still pay 15% tax in Kuwait. So that will become a double taxation for that foreign shareholder, because the foreign shareholder will pay taxes at 49% share profit sharing in Kuwait, and the company would pay taxes in UAE on the entire revenue. So that will become a double taxation. But then it would be interesting to see whether the UAE tax treaty would bring any a benefit or tax credit in UAE for the foreign shareholder which they pay taxes in Kuwait. Yes, Rami.
Yeah, exactly. I think mixed companies, it's a bit unusual here where foreign shareholders are paying tax. So yes, mixed companies will have to have a look at what relief they can apply or to avoid double taxation. Yeah.
Yeah.
Ramya. Yeah.
Thank you, Fahim. Thank you, Naveen. I think we captured, in a sense, an entity which would be effectively managed and controlled in the UAE for a Kuwaiti setup. But one of the other aspects is what happens if the UAE company is essentially based out of a free zone. So while it's not applicable for in the Kuwaiti context, this would be something that needs to be looked at, and it'll have to be looked at from how another tax jurisdiction with a higher tax rate would perceive this bit. So that's another question that we need to look at, just in case where the effective management and control of an entity such as a European entity with more than 9% tax rate is being effectively managed and controlled out of the UAE. I hope this clarifies, and we'll move on to the next
Rami,
concept.
I'll just pause here, and if you can please go back.
Yeah.
It's a quick one. So in the same case, because a lot of Kuwaiti investments are the investment incoming Kuwait through the free zone companies, and normally the free zone companies are foreign companies which are non-GCC. So in case where the free zone companies have the structure where the free zone are investing 100% in a Kuwaiti company or 49% in Kuwaiti company. So normally, I mean, we will see in the next slides that if the free zone companies are not subject to tax in UAE because of the law, in that case, if the effective management and control is in Kuwait, I mean, we will still, that's a gray area. We'll assume that the Kuwaiti company would not pay any taxes in the free zone. And again, it's an assumption. But what if, I mean, we'll see it in the next slide, if the free zone company is subject to tax in UAE, right? In that case, still the Kuwaiti company would be subject to tax in the free zone. That's again a gray area to be looked at. So to clarify that, if a free zone is doing investment in Kuwait, right, and if the free zone become taxable in UAE by way of effective management and control, can the Kuwaiti company be again seen as paying taxes in UAE? So that's still a gray area which one need to look at once the law would be published and how the gray area has been addressed. Yes, ma'am.
Yeah, some very interesting questions there, and we're happy to walk you through some of these scenarios which may apply to your businesses. Right, so let's move on to the next bit, just around exempt persons. So the federal and emirate governments and the departments and their departments and authorities and other public institutions have been exempted as taxable persons. Wholly owned UAE companies that carry out a sovereign or mandated activity that are listed in a cabinet decision are also exempted. Businesses engaged in the extraction and exploitation of UAE natural resources that are subject to emirate level taxation, that's another category which is exempt. Now, charities and other public benefit organizations subject to them not carrying out any other activity would also be able to avail this exemption, subject to certain additional assessments. Finally, when we look at, say, investment funds, going back to the transparency, a transparent entity concept, again, would be able to, subject to meeting certain relevant conditions, be able to claim this exemption person status. So there is another question around whether a Kuwaiti company which is wholly owned by the government, would this entity be eligible to be an exempt person? So Naveen, what are your thoughts on this?
Yeah, so what we have seen, from a Kuwait perspective, that as per the Kuwait Zakat law, if a local company is wholly owned by Kuwaiti government, then they are not subject to tax or zakat, rather, I would say more specific. So, but in case if it's a foreign government is owning shares in a Kuwaiti company, which is a foreign government holding either 100% or it's a mixed government, like different GCC. We have seen in practice that they may not enjoy the same exemption of zakat. So it will be interesting to see that if a Kuwaiti government company is owning 100% share in UAE, whether they will be able to enjoy the same exemption which a UAE government is enjoying. Yeah, so that's a gray area which we are trying to see when the practical implementation will happen. Yeah.
Right. All right. So I think the next concept is around free zones. Free zones are very integral to how businesses are undertaken in the UAE. Uh, the as it stands, the public consultation document does provide certain requirements around free zone persons and how they run their businesses. So all free zone persons, companies or branches would be subject to a 0% rate provided they maintain adequate substance, comply with regulatory requirements, and do not have any other mainland sourced income except for passive income. There are certain exceptions to this rule, and to explain that further, we'd like to walk you through an example. So, um, so under this example, you have a free zone company 1, which is based in the free zone A, and any income it derives from the rest of the world, including Kuwait company, would be subject to a 0% tax. Now, assuming this free zone company 1 is engaged or is earning income from free zone company 2, be it in the same free zone as free zone company 1 or in another free zone, again, the income which these entities would derive from each other are also exempt or are also subject to 0% taxes. What happens if the free zone company is dealing with a mainland entity? Now, in case, and we have seen that there could be certain groups which are headquartered in the free zone, and maybe rendering certain headquartered services to a group entity on the mainland. In this case, there could be some payment which the free zone company is getting from such an entity on the mainland. And again, this is an exception to the rule, and it will be subject to a 0% tax. However, one thing to note here is that this expense, right, this expense for that mainland entity would be a non-deductible expense for the mainland entity. The second exception to the rule is any income which the free zone company is deriving from, or any passive income, so to say, for example, royalties or interest which the free zone company is earning from a third party or a group entity in the mainland, is also subject to a 0% tax. I'm sorry, just accidentally pressed the other one. Apologies for this. When we look at the third exception to the rule, so this relates to any income the free zone company is earning from sale of goods to a third party on the mainland, subject to a condition where the customer would clear the goods, so essentially from designated zones. In this instance also, the free zone company would pay a 0% tax on the income derived from the sale of such goods. What is not, apart from these three exceptions, in an instance when there is any other income which the free zone company earns from a third party, this income would taint the entire exemption. So what happens is, even if there is 1 dirham of income which is not by virtue of any of these three exceptions, this would bring the entire income of the free zone company under the taxable ambit, and tax would be paid at applicable rates for the overall taxable income. Now, this is a key point. So apart from these three exceptions, any income, and this also goes hand in hand with the whole purpose of having a free zone company initially, and the regulatory requirements and under which such a free zone company was initially established. And
Ramya, just a
yeah.
quick question there. So, there are different types of free zones, right? You have Jebel Ali, which is fenced off. But then you have others like that are within the mainland and don't specifically have a border. Is there any indication of how tax authority there is going to try to monitor this?
So I think it will be covered in my initial example. So if there are two free zone entities, right? So if there are two free zone entities, and based on the customer contracts, I would think based on the customer contracts which are entered into between those free zone customers, probably that's how you can track. And one of the advice or the discussions that we have been having with our clients is, if you do have, based on your customer contracts, or if you're able to track those mainland customers based on where they are based, it'll be good to just see if there is any income they are earning from certain mainland customers, because that will sort of taint the exemption. Does that answer your question, Fahim?
Yeah, and I guess that leads that clients are probably looking at to structure their free zone operations
That's right.
clearly.
That's
Yeah,
right. Yeah. So
and sort of look to distinguish between mainland and free zone and rest of the world. Yeah.
Yeah. So as part of an impact assessment that we are currently undertaking for several of our clients, is to see if if there is income which they are earning from the mainland businesses and as to your point, whether they need to be segregated as a different entity altogether. So yes, subject to other conditions such as setup costs, or whether they do have entities in the mainland who can absorb that part of the business, so on and so forth. So there are several discussions on along these lines. Yeah. So finally, the last point on this slide is around mainland branches of free zone companies. Yes, the PCD does provide that the entire income of the branch would be taxable because by virtue of being in the mainland. Right. So we'll move on to the next slide, which is around second exemptions. So given that UAE is a regionally headquartered hub, where you have a number of regionally headquartered companies, and you also have a number of holding companies, there is the PCD does provide certain incentives on this, ranging from around dividends and capital gains from sale of shares, subject to certain conditions. So dividends received by an entity from domestic UAE companies. So if and we will go through certain examples to make it clearer for you. So the first point is dividend, which is received from a domestic UAE company would be exempt. The second point is dividend from foreign companies and capital gains from shares of a sale of shares in both UAE and foreign companies will be exempted subject to the following conditions. So the first condition here is a participation exemption, which is owning at least 5% of the shares of the company. And secondly, the investee company should be subject to a corporate tax of at least a 9%. There is also another point around capital gains on disposal of free zone entity shares. Given that free zone, it would be at a 0%, you still are able to claim it subject to substantially earning all the income from shareholding in subsidiaries. There is also a reference to an exemption on foreign branch profits. So UAE companies can elect on an irrevocable basis either elect to claim an exemption for their foreign branch profit tax or claim a foreign tax credit for such taxes. We will spend a minute on how foreign branch profits for a UAE company having presence in Kuwait, right? So what would be the implications for a Kuwaiti branch of a UAE co? And I again defer it back to Fahim or Naveen. What do you think would be the implications in this case?
Yeah, so as I said, it depends. Kuwait tax is very specific in terms of ownership structures, right? So it's really foreign sourced income, non-GCC ownership income that is taxed in Kuwait. Now, if you have if you know, there would be, in the case of a UAE company which is wholly owned by GCC nationals, if that company has a branch in Kuwait, it is still not subject to tax in Kuwait. So then there's no benefit there's no tax credit. And I'm not sure whether UAE would then allow you to take the exemption because it's not being subject to sufficient tax in Kuwait. Yeah. So I think the first question will always be, okay, how are the operations being taxed in Kuwait, if at all? And then you can take a decision whether to elect to continue to pay 15% tax here or in the UAE. And then of course then you have the interaction between UAE and Kuwait with respect to the treaty once it's applied. So will that give you any additional protection or credits sufficiently in the home country? So yeah, it's very case to case depending on ownership structure, taxability in Kuwait. But we wait to see. There's a couple of options that would potentially happen.
All right. Okay, so we will spend a few minutes just around, how do you practically apply these exemption rules. So in this first example, you have a UAE GCC co, which is based out of the mainland and owns a 4% stake in another UAE company. We know that the corporate tax rate is 9%. Now, given that there is a 4% stake in the UAE company, which is less than the stipulated 5%, what will happen is the capital gains on sale of shares of the subsidiary would be taxable. However, given that this is a domestic dividend, it will be exempt. Under the next example, we're looking at a case where you have a Kuwaiti company and UAE GCC Co, which is based out of the mainland, holds less than 5% in the Kuwaiti company. And as we have already discussed that we have along in all our examples, we have also looked at a case where the corporate tax rate right now would be 0%. So in this case, because both those conditions of not meeting the 5% and not meeting a corporate tax rate of 9%, this brings both dividend and capital gains subject to taxes in the UAE. So Naveen, would you like to comment on what will happen from a Kuwaiti standpoint in respect of the dividend and capital gains?
Yeah, so I think dividend obviously and capital gains, there are two things here. So dividend is not subject to tax in Kuwait, right? I mean, so if a Kuwaiti company pays any dividend, because profits are already subjected to tax in case of a mixed company on the non-GCC shareholder, right? And in case of a GCC shareholder, if it's a car, what all those are already paid. So normally dividends are not subject to tax in Kuwait. So if a capital gain is being earned, then to the extent the non-GCC shareholders, I mean, they would be paying tax on the profits which they earn in case they sell their shares in the Kuwaiti companies. So that is the one impact we see and in this case. But the non-GCC shareholder would be not, perhaps in this particular case, would be able to get any benefit of the taxes they are paying in Kuwait if they were to pay any taxes back in UAE, because the treaty so far we're not aware if they would provide any benefits. So it seems that it could be the case that the tax would be paid by the non-GCC shareholder in Kuwait, yeah, on the capital gains they made.
Right. So I think we move on to the next case study where, you know, the UAE GCC company owns more than 5%. Now, while the first condition is satisfied, it is still corporate tax rate of 0%. So both those conditions are not getting satisfied, and we'll have a similar response both in UAE and Kuwait. So in UAE, the dividend and capital gains would be taxable. And to Naveen's point, we'll have to apply the same thing for a non-GCC shareholder. The capital gains would be taxable to the extent of the non-GCC shareholders' stake in the company. Yeah.
Yeah, this is the issue again, where it gives rise to risk of double taxation, because if the tax is being paid in Kuwait by the foreign shareholder, not the company itself that is distributing dividends. Yeah. So effectively, from a UAE perspective, dividends are being distributed by a non-tax-paying entity. Yeah. So then that means that you may get then a pickup of 15% tax in the UAE. At the same time, the foreign shareholder in Kuwait has paid 15% tax on share of profits or the capital gain. So then that is where your double taxation will arise. And I don't think the treaty will be able to cover that actually, because of the way the specifics of how Kuwait tax applies on foreign shareholders in local companies. Yeah.
Okay. Thank you. I think there is another set of examples where we don't have a UAE GCC co, but a UAE free zone company. And in the interest of time, I'm just going to quickly skim through this, and we can spend a few seconds on how it impacts Kuwaiti companies. Essentially, in the first example, where the stake, the shareholding is over 5% and the corporate tax rate is 9%, where a UAE free zone company owns over 5% in a UAE company which is based in the mainland. Again, dividend is exempt in this case because it's domestic, and capital gains will be exempt again because it's satisfying both the conditions. Under the second scenario, you have less than 5% of stake in the UAE company mainland. So dividend again is exempt because it's domestic, but the capital gains would be subject to a 0% corporate tax rate, given that it's a passive income for the UAE free zone company. Under the third case, we have a UAE free zone company which owns more than 5% stake in a Kuwaiti company. Again, the rate is assumed at 0%. Both dividend and capital gains would be subject to tax because it's not meeting the second condition. And same, the impact on Kuwait would be similar to what we witnessed in the earlier slide. And the fourth scenario is where the stake in the Kuwaiti company is less than 5%. In this case, both those conditions are not really met. So the dividend and capital gains would be subject to 0% tax rate, and the Kuwaiti impact would also be similar to what we've seen before. Right. So we will move on to the next feature, which is again critical and a point of discussion with a number of groups, because there is a provision to look at tax grouping. Now, UAE residents can opt to, uh, become one tax group if the parent company holds at least 95% of share capital and voting rights, and all the group companies have the same fiscal year. Free zone persons that are also part of the group and they benefit from the 0% CT rate cannot be part of tax group. So by this, we mean that a free zone entity which has elected to be part of the CT regime can be part of the tax group. But if it's opting in to continue to be taxed at 0%, such an entity will not be able to be part of the tax group. There is also certain guidance around intra-group transfer of assets and liability release, which will be available between UAE group entities that are at least 75% commonly owned, and assets or liability remain in the group for a minimum of 3 years. So there are certain provisions around the restructuring and reliefs to support that. Moving on, there's also a reference. The next concept that we'd like to look at is losses, and then we will follow this up with an example which would cover both. Now, when we talk about losses, tax losses can be carried forward indefinitely. The only thing to be mindful of is that the tax loss relief for losses before the effective date of UACT, so prior to the 1st of January 2024 for most groups, would not be available. And this is also not available from activities which are otherwise exempt from UACT. Now, when, as you're all probably aware, to the extent it is part of the tax group, you can offset losses, but a member of a group which is not part of a tax group is also able to transfer losses to the tax group to the extent of 75%. So what happens if you look at the second last point on the slide, so total tax loss offset cannot exceed 75% of the taxable income of the company receiving the transferred losses. Again, this will get clearer from the example that we presented. So moving on to the next slide. So under this scenario, we have looked at, say, a company which is based in the mainland and it has a taxable income of 300 million. It owns a 100% stake in C company, again, a mainland entity with a taxable income of 100 million. Now, they can form a tax group. This is entirely possible. Now, assuming we have another company, which is BCO, which is based out of the free zone. Now, in this case, BCO can elect to be subject to regular CT. So if it sort of elects to be part of regular CT and not subject to 0% CT, yes, all three entities can then become part of the tax group. Now, assuming you have a fourth entity, DCO, which is again part of the mainland, and ACO holds 76% stake in this company. Now, based on the provisions that we were just going through before this slide, there is a possibility of the losses of DCO can be transferred to the tax group. Now, this is only subject to the 75% stake. So there are two conditions. One, that ACO should have more than 75% stake in this company DCO. Yes, that condition is met. And the second condition is that only 75% of the total taxable income of all three entities part of the tax group, right, would be allowed. So in this case, the total comes to 550 million, and 75% of 550 million is 412.5 million. Given that DCO's losses are 320 million, they are able to, utilize this against the taxable income of the tax group, even though DCO is not part of the tax group.
Just to highlight, I think to make clear that tax groups cannot be cross-border, right? So you cannot offset losses in Kuwait with against profits that you make in the UAE. So I think this is very UAE specific. Yes.
That's right. And just another point, for most of you who already have businesses are already part of VAT groups, and the UAE CIT grouping is also significantly different from VAT grouping. Just in terms of, say, the conditions, the UAE CIT looks at 95% shareholding, whereas VAT can be as low as 50% shareholding. Also, free zone entities can be part of VAT tax grouping, which is not the case in this for UAE CT law, unless you elect to be part of the regular CT regime. So I hope that clarifies, and we'll move on to the next section, which is around transfer pricing. Again, we probably need a dedicated session for transfer pricing given the complexities, but what we'll try to cover here is just what the CT law really provides. So the public consultation document provides differs back to the OECD TP guidelines on pricing intra-group transactions. Uh, they specify that all transactions with related parties and connected persons are required to be at arm's length. Uh, Arm's length is an age-old principle. It means that all your related party transactions are required to be aligned with what unrelated parties do charge, in similar transactions on similar circumstances. So that's how best and simplified I can put an arm's length principle for you. Um, the OECD TP guidelines do provide very, it's a very robust document which provides intense guidance, and the pricing analysis would be determined using the principles prescribed there. PCD does provide for certain reporting obligations, which is required from the taxpayer. One is TP disclosures. So TP disclosures are essentially, simplified one simplified document which provides details of the intragroup transactions, the method that has been used to demonstrate that it is at arm's length and the value of the transaction. And it's often submitted along with the corporate tax return. So a TP disclosure is required for your transactions with related parties and connected persons. There is also the PCD also provides that a master file and local file is required to be maintained in respect of related party transactions by a specified due date and specified threshold. So what we are waiting for now is what the threshold would be for these obligations, what the due dates would be, whether it's a maintenance requirement or you need to submit it with the authorities. What are the categories of transactions that need to be disclosed? There is a significant wide definition for which covers related parties and connected persons, which sort of brings all entities and even individuals related to the taxable person within the ambit. So the transfer pricing legislation would essentially be robust. Um, what is yet to be seen is whether the domestic transactions would also be required to be, at arm's length, and the extent of documentation that would be required with respect to domestic transactions.
Yeah, and as you said, I think TP is very complex, so I think you need to spend a lot of time on this. Maybe just in the interest of time, Ramya, we can go to the penultimate slide, which talks about, the Kuwait co-holding various entered the next slide after this. But maybe if you want to spend maybe a minute here just on the
Just spend
administration
a
side.
minute.
Yeah.
So essentially, calculation of taxable income, we are waiting for certain additional guidance, but any excessive amounts may not be allowed as deductions. So there needs to be further guidance. Yes, there is something around interest deductions to be capped at a 30%. Unrealized gains or losses on capital items are not allowed as deduction. And of course, we spoke about related party payments to free zones would be non-deductible. So there is some indications. We start with the accounting profit and loss as under any legislation, and then we'll have to adjust it to arrive at the taxable income. We already spoke about the requirement to file a CT return and tax payments to be made within 9 months from the end of the fiscal year. There is no provisional or advanced tax payments, and foreign tax credits are allowed to be offset. In terms of administration, yes, there is some the PCD does talk about certain things, but again, the granularity and the procedures around it are still awaited. So I think with that, we wanted to, just present a very just a summary of what the tax liability for a Kuwaiti group under different structures would be with the presence in the UAE. If you look at this slide, what we've tried to see is a Kuwait company would have presence in the UAE either in the form of a subsidiary either in the mainland or a free zone. It could have a branch presence either in the mainland or the free zone, or it could also have a permanent establishment, again, either in the mainland or free zone. The UAE corporate tax would be applicable at 9% or 15% for mainland operations, subject to what we discussed based on the size of the group operations. Now, a free zone entity would be subject to a 0% rate. Again, it can elect to be part of the applicable CT rate, which is 9% or 15%. The withholding taxes on any income, any dividends, or any interest or royalties which are paid from UAE to Kuwait would all be at 0%. Fahim, I will let you take through what the implications would be from a Kuwaiti standpoint.
See, again, in Kuwait, it's going to depend on the structure. You could be subject to 0% tax in Kuwait if you're a basic WLL, or you have your zakat or NLST if you're listed, or a Kuwait shareholding company. So, I think the impact really is very clear from a UAE perspective, is that you're most likely going to be at 15% or 9%. And I think I just see one of the questions actually just popping up is that if you are a worldwide group with greater than 750 million euros, and you fall under as you said, the higher rate, does the branch then also become taxable under that 15% rate? But I think the question is that if that group also had a Kuwait branch, that would also be subject to the 15% rate or not. Because my understanding is that if you fall under the 15% rate globally, you are then paying 15% on global worldwide income anyway.
So I think there are two rules to that, Fahim. One is to determine what that liability would be, but given that Kuwait is not an inclusive framework member, they don't have the taxing right on that 15%. So it may well be that another subsidiary or an intermediate parent entity may have the taxing right to that 15% taxes, but again, it will have to be looked at on a case-by-case basis.
And I think because we've been talking a lot about withholding tax being nil, and it's at 0%. It's not that there is no withholding tax. It's at 0%, which leads me to believe that maybe the intention is to increase it at some point in the future, right? Because it'll be a lot easier to implement.
That's our feeling as well. Yes. Because what happened was that during the initial announcement, it said nil, but then that was later changed to a 0% in the public consultation document.
Of course, in Kuwait, we don't have withholding tax either. We have the retention system, which would stay in place as required. Even if you are now a tax-paying entity or branch in the UAE and you've suffered retentions in Kuwait, I think from a Kuwait perspective, you would have to go through the normal process of obtaining the no objection letter and compliance and disclosures here. I think the only additional impact is, I think, when you have intergroup transactions, so you've got a branch or subsidiary in Kuwait and UAE, so those interactions and the retentions and withholding taxes there, I think will still need to be applied as normal. So that is something that, but it's clear that UAE doesn't have a retention system. It is in withholding tax, but at 0% currently.
That's right. And I think
Sorry, go ahead.
Based on the recent, tax residency rules also, I think the UAE is also rejigging how you obtain your tax residency certificates, and just streamlining those processes. So yes, we are also expecting certain changes along those lines to to sort of aligned with the UAE CIT regime.
Yeah, because currently tax authority here in Kuwait require a nationality certificate confirming that you are a UAE company, or so I think those processes will come online. There were a couple of questions on real estate. Are there any specific exemptions for real estate companies? And one of the other questions was, as a Kuwaiti individual owning property in the UAE, is that subject to tax? I think we covered that individuals are not subject to tax, but it depends on if it's owned through a corporate structure, I believe. Yeah. But generally, is there any other exemptions or matters to think about when real estate is involved?
There is something around funds which you'd have to look at, but apart from that, nothing that comes to mind. Yeah.
So, in a Kuwaiti individual owning property in the UAE would still not be subject to tax as long as it's in its individual right.
That's
Yeah.
right.
Yeah.
Yes,
Yeah.
that's right.
However, if the property is held by a UAE company that's been set up, then 15% tax would apply.
Correct.
Yeah.
Because then it'll also be looked at as a commercial activity, and you'll have to have a license. But as I mentioned, in its individual capacity, any rental income would not be subjected to this. And that's
Another question was regarding Kuwaiti companies owning free zone companies in the UAE. Now, again, I think the ownership of a free zone entity is not really the focus. The focus of a free zone is whether they are interacting with the mainland companies or transactions, or whether they're solely for free zones. So maybe we could cover that just briefly again.
So, right. So a free zone entity historically was because of the 100% ownership and, for free trade, and they were allowed to only transact by law to transact within the free zone entities or for their overseas operations. So to keep that in perspective, they want to still go ahead with the incentive and provide them the 0% rate. However, what we have seen is it was not actually practiced. So a number of free zone entities were also transacting with mainland entities. And until now, because of no tax system, that was possibly possible, but now that will have to be curbed. Having said that, based on, since the PCD, there have been a number of discussions around what would be the law in terms of free zone, and I would recommend we wait also for the CT law to be published to actually get further guidance, and if there are any changes to how free zones would be taxed in the future, because there is some discussions around those as well.
And that would probably include clarification on whether DIFC is treated the same as Jabal Ali, or Jabal Ali is treated the same as ADGM, for example.
Yeah,
So
because
I
there
think
are certain tax holidays which are available for over 50 years, so we have to also see what will happen to that. So that I would think we should wait for the CT law to get further clarity on the treatment of free zone entities.
Yeah. So I think we're coming up to the hour. Maybe just the wrap up, the next slide in terms of points to consider. I know there's a lot. As I said, this session was just intended to give you the highlights and really start to think about what potentially within your organizations you could do. But yeah, Ramia, if you could just briefly go over some of the things that we really need to start thinking about, and then that would be great. Yeah.
So there are a number of topics we covered during the course of the session, but some of the things which are separately mentioned here are just around the administration. So you will have around the CT returns. So CT returns would be, there would be a separate CT return, and you will have a need to prepare a separate return under the BEPS 2.0, GMT rules. So while there is so that's something that needs to be clarified to the extent of the disclosure that needs to be presented in either return. Of course, transfer pricing considerations we discussed. We would like to see what would happen to the economic substance regulations and the notifications and reporting that a number of groups are doing in the UAE. what will happen to those rules post corporate taxes? Would we continue to have that? Of course, we spoke about effective management and control in detail, the interplay of free zone and mainland entities, and participation exemptions. So essentially, businesses really need to now start looking at their operations because there is also a possibility of, we are expecting anti-avoidance provisions in the CT law. So one also needs to look at what the impact of that would be. These are just some of the considerations. Of course, it would be critical to look at how this would apply to individual businesses on a case-by-case basis.
And I think we have to wait for further guidance in terms of templates for returns. All the detailed stuff is yet to come, I presume.
Yeah.
Yeah.
That's right.
Yeah. So I think we're at the hour now, so I appreciate that there's a lot to cover. I think this is, as I said, feel free to connect with us separately for specific questions. Just to update you, we have launched our Kuwait tax guide as well, more relevant for those businesses having operations in Kuwait, whether foreign or local. So I think you will see that being launched on our social media platforms later today. Can be downloaded as of now, so it's a live document. We also have our Doing Business in Kuwait and other publications available. And of course, Ramya, I think you can provide links to the UAE publications that have already been issued regarding the topics and the updates. So I'm sure people can register for regular updates from the UAE firm and tax alerts that are coming out on this topic. Yeah. So.
Certainly.
So thank you, Ramya. Again, thank you, Naveen. Thank you, everybody, for joining. We hope that this has been interesting and thought-provoking. Yeah, we hope you enjoyed the session, and thank you for attending. Thank you.
Thank you for attending. Bye-bye.